Met de zomervakantie voor de deur herhalen we de komende weken een aantal podcasts uit de Masterminds-reeks. Let wel, omdat het al oudere afleveringen zijn, is sommige informatie ondertussen wat achterhaald. Maar de voornaamste lessen en inhoud van de afleveringen blijven uiteraard gelden. Voor we de aflevering starten, een korte disclaimer. Deze podcast is op geen enkele manier bedoeld als beleggingsadvies. Alle cijfers, koersen en bedrijfsgegevens die erin aan bod komen zijn louter ter informatie. Welkom bij Masterminds, een podcast van Inside Beleggen en Trends. Ik ben Jeff Boortmans. Elke aflevering spreek ik met bekende beleggers, fondsbeheerders of analisten over hun beleggingsaanpak, hun visie op de markten en over interessante aandelen en bedrijven. In deze aflevering is Didier Saint-Georges te gast. Hij is lid van het strategische investeringscomité bij de Franse vermogensbeheerder Carmignac. Ik zag Didier onlangs een heel interessante presentatie geven over de verschillende fases van de investeringscyclus en over welke activaklassen het best presteren in welke fase. En daarom heb ik hem gevraagd om dat nog een keer te komen vertellen in de podcast. Dus in deze aflevering zul je onder meer horen welke cyclische sectoren het best presteren wanneer de economie terug aantrekt, of welke fase in de cyclus het gevaarlijkst is voor beleggers en hoe ze zich daarin best positioneren. En uiteraard hebben we het ook over de uitzonderlijke situatie waarin we nu zitten en wat dat betekent voor beleggers. Maar eerst vertelt Didier hoe hij als belegger begonnen is en welk parcours hij al heeft afgelegd.
It really all started back in 1987. At the time, I was already in the banking business, but I was doing aircraft financing, and that's the time when Didier Carmignac, who at the time was heading a stock brokerage house. He was not only a fund manager. He hired me at the time, 1987. And of course, if some of your readers may remember that already then markets were quite difficult. So it was an interesting training for me as a first experience. What's interesting next is the fact that Edouard then moved on to the pure investment side, the buy side, creating Carmignac as an investment house. But I didn't follow him. I moved to JP Morgan, where I stayed for 10 years in New York, in London, and Paris, and then moved on to Merrill Lynch, still on the brokerage side. I was their managing director, was in charge of equities and equities derivatives, stayed there as well about 10 years, 9 years exactly. And then, interestingly, during all this time, Edouard, who had become a pure asset manager, was my client. And so after 20 years, basically, he suggested that I join him again on the investment side. And that was 2007. And since then, I've been working at Carmignac as a member of the Strategic Investment Committee, really trying to help figure out which investment strategy to implement in the portfolios, and also using that insight to share with our partners, our clients, what we're doing with their money, how we see markets and what we're doing.
Yeah, and when I hear 1987 and then 2007, 2008, I mean, quite some crucial years in investment terms. Yeah, how did that shape you as an investor? Those 2 years.
Yeah, it's a good observation. Probably it helped me understand that when you want to perform over the long term, there are lots of things which we all know about, alpha generation and portfolio construction and all these nice things. But one of the things you have to do is to stay alive, because true market crises do happen. And when you start in this business in 1987, very quickly you understand that staying alive is the first condition, not getting wiped out by a financial crisis, so that all the good work you would have done for 10 years would just get washed away by a market sell-off. So that's really what it is. I think long-term investment is about great ideas and staying alive.
Good advice. But we've asked you onto the podcast because you've given a very insightful presentation on the economic cycle and the different phases that it goes through, and how investors can look at that and what they can learn from it. So I'd be interested in going through this cycle with you, phase by phase, and maybe a good starting point would be the beginning of each cycle, which is, if I understood correctly, we go from a low point in growth to a low point in inflation, which you characterize as the first phase. But how can we recognize this phase? What actually happens here?
The first thing for everyone to have in mind is that basically, whether you talk about the economy or the markets, they are made of long-term trends which can last decades, and within those trends, you have cycles or mini cycles. And of course, the art of investing is about both catching the long-term trends and optimizing what's happening during those short cycles. And indeed, an economic cycle is what life is about, really, in the economic world. It's basically the basic fact that life is cyclical, and there always a point where you reach a stage where the previous phase basically has been a slowdown, for whatever reasons, and we will go into that certainly. But a point when psychology start to change, because there was a slowdown, investment was down, interest rates went down, inventories went down, and so it always reaches a point where it cannot go much further down, and so companies start rebuilding their inventories, consumers start using their savings, um, and that's how cycle starts. Now, inflation is a late cycle phenomenon, so usually it doesn't start immediately when the economy recovers. It starts a bit later. And so you have that first phase in a cycle, this first quadrant, so to speak, where the economy starts improving, and inflation that doesn't rise yet until it does start.
And how could investors recognize this starting point? Because, as you say, I can imagine it's fairly fluid. So what signals should we be looking out for to be able to recognize this starting of a cycle?
It's interesting because you can be an economist, and you try to recognize a cycle using that economic data. So what's happening, as I was alluding to, looking at inventories and the behavior of companies, the behavior of consumers, and so on. Or you're an investor, and not, of course, you listen to what your economists are saying, and starting to anticipate, but you look at the market, and it is one lesson you learn from a few decades on markets, which is that markets are pretty efficient, and you always have to be careful to pretend that the market doesn't know that the market is stupid, because actually one of the signals that you're entering that first quadrant of economic recovery is when cyclical stocks start outperforming defensive stocks. That is something which basically you watch the market, you listen to the market telling you that the internal dynamics, the sector rotations start taking place. So the market starts sniffing that the recovery is in the making. Then you check with your economist whether he would tend to agree, and little by little you get the confirmation that this is a train that is starting from the station and that you want to catch.
What would typical examples of these cyclical stocks be? What sectors are we talking about?
The sort of early cyclical stocks, would be consumer stocks and construction stocks, typically, in industrial stocks, because they're really the one that kick off the economic recovery. We will come in a second, I'm sure, in the next stage of the recovery, where you want to buy late cycle sectors, but really consumer and construction are quite usual sectors you want to be positioned in at the beginning of a cycle.
And what periods illustrate this phase of the cycle? Is there any recent history or past history that you think is a good example of what we've just discussed?
Sure. I mean, we've had over the past decades plenty of those small cycles. One you may remember was 2016. After 3 or 4 months into 2016, that's when the economic recovery started to improve after the slowdown of 2015. Inflation was still very low. Interest rates are still very low, but you could see already cyclical sectors on the equity side starting to outperform.
And then, as you say, the cycle is kicked off in this phase. And then what happens next if we go on to the second quadrant? I presume your growth is picking up. And inflation, what is inflation doing in this second quadrant of the cycle?
It's all about momentum. The cycle or the recovery tends to build on itself. A lot of people are sort of jumping on the bandwagon, basically, and as demand increases, as investments increase, clearly supply has a bit of a hard time matching demand. So typically that's when commodity prices start to rise. There's just a need for adjustment of supply to demand. So that's logical that inflation would start picking up. If really the economy gets really a nice momentum, then you can get something more tangible in the way of salaries. People will just basically consider that yes, production is growing, so employers need more staffing, and therefore employees are in a position to ask for higher wages. So that's typically when inflation starts, which, as you know, is also the time when central banks start sort of waking up and say, inflation is nice, but we've got to make sure we keep it in control. So into that second part of the recovery, that's when central banks will start raising rates, trying to keep control of the momentum.
And I heard you mention late cycle equities and then also commodities. Are these then the two asset classes to look out for in this cycle? And what are good examples of these two?
Yeah, absolutely. That as I mentioned, commodities tend to take a bit of time to adjust the supply to the demand. So that's when commodity prices go up. A bit of inflation and a lot of growth is of course a good setup for equities. So you want to be in equities in that you're still in a growing phase, really. So you want to be in equities, and of course, sort of inflation assets is the place to be. There are plenty of examples of that. I was mentioning 2016 a minute earlier as a good example of a beginning of economic takeoff of a mini cycle. And 2017 was exactly the follow through. If you remember, that's when commodity prices went up. In that time, for instance, copper price went up 30% in 2017, and the Fed started to raise rates. A good example, of course, is right now, or I should say, the past 6 months. That's typically what you would call a second phase of a recovery when you start seeing inflation signal in the economy, and central banks usually waking up at that time. And of course, what's very interesting this year around is that if it were a normal situation, central bank today would tighten. But it's and that would be another discussion probably. But what's very interesting right now is that we're getting those inflation signals. We're getting very strong recovery. We are typically in that second phase of the cycle, but central banks are saying we will delay the tightening, and so it remains an extremely favorable market for equities.
And is that also usually the phase when we start, maybe towards the end of it, hearing more and more rumors of overheating? Is that a good signal?
Exactly. Overheating is exactly that. That's when the strength of the economy is such that you're getting a lot of tension on the supply side, and it generates inflation. And it's exactly to avoid this overheating that normally central banks do raise rates at that time, as it did back in 2017. So that we are today in the overheating stage, but the central banks are saying, let's run it hot. It's all right.
Yeah, we can come back in a minute into the unusualness of this cycle right now. But maybe as you just came to describe, so we're going towards this phase of overheating, of high growth, and then normally, if things were normal, the economy would, as you describe in your presentation, roll over into the third phase, which is a downward trend in terms of growth, if I understood correctly. But what other factors would characterize this third phase, this third quadrant?
This third quadrant is really the dangerous one, because that's the time when you've gone through the overheating, which has triggered a reaction from the central banks. The bond markets, of course, have reacted to this rising inflation and raising policy rates, and all that is starting to represent brakes on the economic momentum. So that's really the time when the market will start anticipating the economy to roll over, because with the rising rates, inevitably the whole point is to cool down the economy. But as I said, as it happens, inflation is a late cycle phenomenon, and so the economy will start to sort of weaken a little bit. Very little at the beginning, of course, but we basically roll over. But inflation will still be there, so that interest rates cannot come down immediately. And so you have that period, which is very tricky because the economy is rolling over, therefore equities are unlikely to do very well. But bond rates and policy rates remain elevated, inflation remains there, therefore bond markets are not doing too well either. So it's really the time when there's a bit no place to hide. That's the time when that is king.
Yeah. Is this also a phase where fear is the investor's worst enemy?
Uh, yeah, it is. It is a time when basically you have to manage your portfolio very very carefully. A good recent example of that was 2018. If we continue on the cycle we talked about, recovery in 2016, sort of overheating 2017, and then 2018, the market starts sniffing that rising rates will start hurting the economy, but interest rates don't come down, and 2018 becomes a bad year for investors, both fixed income and equities. If you remember, 2018 was a year, at least in the US, where cash outperformed every other asset class. It was a typical third quadrant of the cycle.
And aside from cash, are there any other asset classes that investors might look towards in this third quadrant?
That's a very interesting question, because that's where you have to remember what we mentioned at the beginning, which is that those small cycles do take place within trends. And and it's interesting because 2018 was was, of course, within the trend of what we've had for the past more than 10 years, which is basically slow growth overall. Uh, and therefore, the interesting category there is what's called defensive stocks, really. In other words, the ones that are almost as good as cash, but have some yield. Or do manage to generate some growth, even if the economy is going down. And so within the equity world, sort of a cash equivalent can do reasonably well.
These aren't what we might call quality stocks, right? That's still a different category, or is it in the same realm?
Well, again, here that's where you have to start from the framework and take into account what's specific about the reality of the market. We have this category of what you call quality stocks, which is really high visibility stocks, which you all know are pretty much the large tech names, the ones that have these 5-year visibility and beyond. Now, these will tend to do very well within the trend, this long-term trend that I talked about of slow overall growth. Those outperform, and they've outperformed for the past 10 years, as they should. The difficulty during the period of the mini cycle we're talking about is that because of the rising rates, there is typically at that point in the cycle a compression of multiples. And since those stocks do so well, have so much visibility that they're really growth stocks for the long term, they tend to try to trade on fairly high valuations. And therefore, even if there's nothing wrong with them, they will tend to struggle both in the second and in the third stage of the cycle, simply because they suffer from a valuation compression. Which, by the way, and I'm sort of spoiling the discussion here, but you can already anticipate what will be the next idea, because if you get these really high quality names that only temporarily suffer from a compression of their earnings multiple of their valuation, and it means that at one, sooner than later, because they've retained their growth potential, they will get revalued, and that will be in the next stage of the cycle.
That's where we are coming to. So at the end of this third quadrant, you reach a high point in inflation, and we're still in a slowdown in growth. And then we go towards the beginning of the cycle again, then, if I were to describe it correctly. So yeah, when looking at this last phase of the cycle, what's typical about that one?
Well, that one is a lot easier to manage, because basically you have a slowdown. The slowdown continues, but because inflation is not rising anymore, because interest rates went up, finally inflation peaked and then started to come down, and so it's a much easier period to manage, because you have a slowdown with falling interest rates. And so number one, of course, it's a good period of the cycle for bond investors. That's when they do very well. That's a typical slowdown. So the most recent example, really compressed, was the first trimester of last year. Of course, when you get a very big slowdown, you want to be in bonds. But as we touched on just earlier, in the equity side, despite the fact that the economy goes down, because interest rates do go down as well, and because valuations were compressed in the previous stage of the cycle, then those high quality, high visibility stocks that we touched on, then they do very well too. They benefit from the fact that finally interest rates do go down. So that's a period when you want to be in bonds and in these days you would call the large tech names, which is very much what happened last year.
And are there any other sectors that you might describe as defensive, but defensive growth? Or
The thing is that your bond proxies will do well. You want to be anything that looks like a bond. So you get a lot of sectors in that respect, utilities and so on. The big advantage of the growth stocks, which was not, of course, 20 years ago. You didn't have as much the Amazon, Google, and Apple, and the rest of it as high visibility, high quality names. But today you do, so that you don't have to take just bond proxies. Here you have much better than bond proxies. You have bond proxies plus growth, and of course those type of names will do extremely well, which, as we know, is what happened last year.
and pricing power, is that also a very important element to look out for in this cycle?
Well, pricing power is going to be very useful in the previous quadrant. The one when you still have inflation, but the economy is slowing down. So the what I called the dead zone. And here, typically economically, the companies that do suffer rising costs, but can pass them on to their clients because they have this pricing power. They manage to defend their margins. So economically, they keep doing very well. The problem is that from a market standpoint, that's not necessarily reflected in the performance of the stocks, simply because of what we mentioned, which is multiple compression when you are at that stage. So it's like a spring that you compress. Those type of stocks, they underperform, whereas economically they are doing extremely well. And if you look again, if you consider we are today in a period when you have this inflation, building up. Economically, you look at the Google, Facebook, and the rest of it; they are doing extremely well, but it doesn't really pay in terms of market performance. Because you get this multiple compression, and I would argue that when we reach the stage where the economy rolls over, uh, then they will very strongly outperform because economically they've remained very strong.
Yeah, as you mentioned, we're currently, yeah, so to speak, in the second phase where we go from a low inflation point to a higher growth. The US is a bit more advanced than Europe, but I mean both economies are more or less in that phase. And as you said, normally we would roll over into the third quadrant if monetary policy were to act as it did before. But there are signals that this time might be a bit different. I don't know how you are currently estimating the phase that we are in and where it might go, because you've mentioned, yeah, what you call a concept of escape velocity, where instead of rolling over into the third quadrant, we might go somewhere else. Where is that?
Yeah, that's when you move from the technique to the art, because once you have that framework, it's all very well to have a framework, but of course life is not nicely separated in four quadrants, which you can exactly time. Part of the art is to sense how long the economy is going to remain in a quadrant, how fast it's going to go through the quadrant onto the next. And that's where you have to use your judgment, and that's where, of course, it's very difficult. As it is right now, the whole economic policy, in particular in the US, of course, is about prolonging basically that period, running the US economy hot, and arguing that the structural downward pressures to inflation, the ones that are linked to the long-term trend I talked about, are powerful enough that the short-term, cyclical inflationary pressure will not be enough to create so much tension that central banks will finally have to raise rates. So we are in that period where the market does believe what central banks are telling them. which is basically, the economy will keep growing and inflation will not get out of control. And as long as the market believes that, it becomes, sort of a self reinforcing, and so we were kept in that second quadrant. But you really have to keep watching it, because if you look over the past few weeks, or even yesterday, I would argue, it was very interesting. You get strong inflation prints, but the typical fangs, those growth stocks we talked about, do extremely well. So the market is like schizophrenic, saying, well, we might get a prolongation of the second quadrant with rising inflation, but I, I would not bet against those growth stocks because we're not quite sure the whole thing might actually roll over, before the market thinks. So it's interesting. You get inflation prints, but interest rates go down and growth stocks outperform.
Yeah, you've been in the markets for so long. Have there been any other periods that are a bit similar to this one?
No, no, I've never seen such an orthodox policy. When central banks started quantitative easing in 2009, it already felt revolutionary. But we are light years beyond that today, and what central banks are doing in terms of accompanying budget policies, which themselves are of historic proportions. You've never seen in peacetime U.S. government running 20% deficit, to jumpstart their economies. So no, we've never seen it, and that's why when you have that, and you also have this pandemic, and when when an economy, or 80% of the world economy, stops completely, and then the following year, not only the economy reopens, but consumers have huge amounts of savings they can spend, and the governments are spending hand over fist to help the economy, then very strange things can happen. And that's what's going on, really. And so you have to be humble, because you can't just apply a framework and say it's got to follow the framework. No, I think the framework helps understanding what may be happening, but you really have to be humble and see really what's happening.
Yeah. Never a dull moment in markets. Maybe to wrap up with, because when it comes down to be able to navigate this, you at Carmignac, you speak of a barbell approach to investing. And for those who don't know what a barbell is, it's a weightlifting bar, and at both ends you have different weights. So you have the concept of balance in this. But could you briefly take us through this barbell approach that you speak of, and how investors could apply that, or could look at that?
Yeah, it's very important. It's an alternative to the good old idea of diversifying a portfolio. And the problem with the broad diversification is that you end up you're just doing very average, and you own lots of things you shouldn't own. So having a very broadly diversified portfolio is not necessarily the best way to manage risk. Barbell investing is about positioning yourselves at just the two ends of the spectrum, and based on the discussion we've just had, I would really argue that that's the right approach, precisely because the markets can go in two radically opposite directions going forward. It can go into further overheating, and then you want to be in inflation assets, basically, or all this end in tears. The cycle finally prevails, and everyone is just today too optimistic about the economic growth going forward. They do get disappointed before you know it, and therefore you want to be able then, as I said earlier, to survive. In other words, to still do well, despite an economy that would strongly disappoint. And so you own inflation assets like commodities, as we talked about, just as a good example. And you own also those, high growth, high visibility stocks, because these will do well even if everything sort of ultimately disappoints. So that's what it is, and you avoid all these things in the middle, which won't help you perform really.
And then when the cycle rolls over, the barbell also changes, if I understand correctly. You change what you put at both ends of the spectrum in your investment portfolio.
Well, if you go back into a clear visibility on the move to the next quadrant, then you don't really need a barbell anymore. You can really say, okay, I understand now the direction. The move has taken place, so you don't need sort of a risk management as much. Barbell is really a risk management tool, and because of this quite unique setup that we're in right now, I think it's extremely helpful.
Yeah, it's a very insightful and visual aid also for investors. But it was very interesting in hearing your views on the markets and how you approach investing in these strange times. So thank you very much for your insights and your time.
Thank you for your interest.
Tot zover deze aflevering van de Masterminds podcast. Bedankt voor het luisteren en aarzel zeker niet om hem te delen met familie, vrienden en kennissen en om een recensie achter te laten via uw podcast-app.
Deze podcast kwam tot stand met de gewaardeerde steun van Keytrade Bank, de onbetwistbare marktleider in online trading in België.